And Ajay, good afternoon. Did you expect that on the first day of the series, you would see such a big bounce on the market?
No, not exactly, Pankaj, but the overall what is supporting this market was that it was extremely oversold, and so the bounce that came in yesterday in the afternoon has continued in the new series as well. Second is that there are thin volumes, lack of participation, and probably some amount of NAV dressing for the year end going on, and some interested buying in select counters to manage the index. I think those could be some of the explanations for this bounce today in the market.
As far as DIIs are concerned, if FIs were selling 600 crores earlier on a daily basis, DIIs were buying 450 to 500 crores, and there were some concerns that their money would finish. But in the last 3-4 days, the amount of net sell which is coming in, almost 1.5 times of that is what DIIs are buying, which means more money is coming in the system.
Yeah, Pankaj, as we had discussed in the last time I was on your show, the ELSS money will start coming in now. Especially in the last quarter, we get about 10,000 odd crores of money for the ATC, Section ATC tax savings in the equity-linked savings schemes. So I think part of that money would be now starting to get deployed, and that will only accelerate. So you have about 4,000 crores that comes in terms of SIPs, and that if you divide by 20 working days or 19 working days, gives you a starting balance of roughly 200 crores and per day. And then 200 crores a day. And on that, you add on the inflows that are coming in. So both insurance as well as mutual funds. Plus, I think some of the EPF money could be getting deployed. So that could be some of the explanation for what is exactly happening.
As far as, Jan month is concerned, there could be a lot of volatile moves in the month of Jan because of corporate results, what happens into US, run up to the budget or noises around the budget. You think Jan will be a very important month to decide the direction and flows?
Yeah, definitely. And I think leave aside Jan, tomorrow, what does the Prime Minister say in his address to the nation? January 2nd, Lucknow rally. I think these will be immediate, deciders of the direction of the markets. What is very sure is it's a volatile market. But it is looking like a market which is finding very strong support at 7,900 levels on Nifty. That has been something quite creditable. And given that that kind of support is there, hopefully the market remains range-bound in that 7,900 to 8,300 level. The trigger upwards, of course, will be the budget. What kind of policies does the market anticipate? And so as the budget session starts, the market could start moving up. The other trigger, Pankaj, would be the GST Council meeting. If there is an agreement finally hammered out on the dual structure, the dual powers, which is the last bone of contention between the states and the federal government, I think you could see a bit of a bounce in the market. So budget, GST agreement, and the first 100 days of Trump, what kind of policies does he bring in? Is there a difference between his rhetoric and his actual moves on the ground? I think those will be the keenly watched features which will decide the direction of the market.
Some of the depressed sectors like pharma and IT could be in focus because of policies. There is very limited impact on these companies.
Yeah, definitely. I think IT, the correction was overdone. December, we have seen a better performance from IT. Expectation is that Trump will not be as bad for IT as the market has factored in. So there could be a little bit of a bounce coming from IT. Again, it's not a domestic sector, so it benefits. Pharma, not being a domestic sector and export-oriented sector should have been a positive. But the FDA issues for a lot of the pharma companies and the antitrust pricing pricing case in the U.S., which could expand to more companies as well, including some more Indian companies. I think that will be an overhang on pharma for now, Pankaj. So pharma, I would say avoid unless you know a company well and you see they don't figure in either a 483 from the FDA or they don't have much to do on the antitrust case. I think then it can be looked at. Within that healthcare space, I think the hospital-based companies, those could be looked at as well. That is, a defensive sector, and it's giving growth. So, the demand is assured for their services, and the growth is there. So, with good margins, those could be looked at as well.
As far as pharma is concerned, with especially what has happened to Divi's lab after the form 483, you think it is again just telling that it's not an absolute risk-free sector, and that's why high valuations for a lot of companies may not sustain?
Yes, and it's been so true for the last 1 year. If you see, the pharma index is down 15% year to date. So it has been an underperforming sector for the last 1 year. Valuations were high, and we used to justify them on two grounds. One, they have very stable earnings. And second, there's a good earnings growth with very little capex requirement and brilliant ROEs. So it looked like a sector which couldn't put a foot wrong. But where they've gone wrong is the irresponsibility of the management in not, bearing in mind the compliances of the FDA. So something which is so life-threatening was really very casually, forsaken by these management. So as minority shareholders, we have to be very wary of these managements. They are either incompetent or they are fraudulent, both of which is as bad, and it has to be avoided. So that's why you see the sector is out of favor, and it will be very difficult to attract foreign money into this sector if these kind of practices continue. The third part is the regulator is not changing the rules. We have been asking that mandate. Moment of 483 is there. The management receives it within half an hour. They should put it on the stock exchange site. It's a material change that has happened to your business. Most of the time we come to know when a brokerage pulls out a report or somebody in the media like you goes to FDA and pulls out a 483, that's when we come to know. So as minority shareholders, we are really running in the dark against the insiders. Again, not a good position to be in.
NBFCs or microfinance companies are looking interesting after correction, despite last 3-4 days up move?
I would not say so. I would say stay away from microfinance. Whatever channel checks we have made, Pankaj, it's showing 85 to 90% collection efficiency. So you have impairment of assets. You have credit costs which will go up. Right now there will be window dressing because RBI has given an extra 60 days. And most of these companies were still moving to the 90-day window. Most are in the 120 to 150-day kind of range. So easily at the least they will get 150 days from November 30th to recognize impairment of assets. So you will not get to see the real picture for quite some time. I would say MFIs give it a miss for now. Even now the valuations are not very low. Relatively they have come down. Some have fallen as much as 30-40%. So you might say yes, there's a technical bounce. Fundamentally, I think there's too much of a risk on the business models because how soon will that cash return? Will those business models based on cash collections come back? I think those are the big ifs, and you're better off going with the steady IDs, the private sector, consumer-focused banks. They will also jump as the normalcy is restored on the monetary side. Better go with them rather than the higher beta names like MFIs.
Which sectors would you be overweight now on?
I think cement, very clearly, it has been beaten down a lot. It will come back. Autos will be a leading indicator. You'll get very horrible numbers come January. As early as Monday, you'll start seeing the numbers coming in. Commercial vehicles and two-wheelers especially will really fall off a cliff for December. passenger vehicles, depending on the waiting list periods. So some companies in passenger vehicles which have long waiting lists will do okay, will have a little bit of growth, 3-4%. All the others will be double-digit negative. So next week itself, you could see some amount of sell-off coming in auto. That's the time to go ahead and grab them. 6 months down the line, auto looks very good again. So it will be the sector leading us out of this morass. So cement, auto, private sector banks focused on the consumer. The bigger NBFCs, which are more urban-oriented, don't have a cash collection component. Housing finance companies, budget will bring in something on both house buyers in tax concessions as well as on affordable housing. Let's see what the Prime Minister announces. Cement will be a natural beneficiary. Metals, I like right now. Only thing is metal is very dependent on two very big global events. One is the Chinese stimulus being continued. Second is Trump's overspending on infrastructure. Some indication you will get also from the oil price. If the oil price stays high, manages to stay in 56 to 65 range, then there is some amount of surplus coming back into the global economy, which will get spent on infra as well, and metals will do better. So metals, I am positive right now, but watch out for the Chinese property market. That will be a leading indicator for how metals will perform in this year.
As far as mid-caps are concerned, do you think they are more vulnerable to a sell-off because of valuations?
Yes, they are at a premium, but again, mid-caps, you have to differentiate between what we call interested buying and what we call genuine fundamentally good stocks. So I would say mid-caps in IT, mid-caps in cement, mid-caps in auto ancillaries, these look quite good. There are some mid-cap pharma as well which have better managements, which have performed very well, don't have 483 overhangs or pricing antitrust overhangs. So there are enough in the mid-cap pool as well. But as I tell the retail investors every time, better off buy a micro-cap, small-cap, mid-cap mutual fund. Let the fund manager do the heavy lifting for you. They will choose the 40 stocks. They will pick out 10 winners out of that, which are multi-baggers. 20 of them will do well. 10 will not do so well. In your own portfolio, it's very difficult to get that kind of a ratio. Fund managers normally are able to deliver like that. So better off there. Direct investments, I think you will have to see sectoral and then go down to company specific. It will be a market determined like that because the economy might take time to recover. You will have to see which are the sectors which have some benefits, as we were discussing earlier, say mid-cap IT or mid-cap cement, for example. Paper I like. I think paper, there's a huge demand-supply mismatch and pricing is there. The demand is growing very fast. Sugar is looking good with all the government action expected and the demand-supply again. So the sugar pack could continue to outperform another 3 to 4 months. So these are some of the ideas, Pankaj.
Ajay, thank you so much for taking out time for us and wishing you and your family a happy 2017.